There we go. All right. We are actually live. Okay. Have to fix the camera. Make sure the lighting is good. Perfect. All right. All right, everyone. Let me just close the door 1 second. Be ready. Hi, everyone. This is Niveen, your local real estate agent with Coldwell Banker. And if this is the first time for you to stop by, then I just would like to welcome you all. And please subscribe to the channel. There are a lot of tips about selling and buying and all about real estate, right? It's the topic of the hour. And today I have a special guest for you. For all of you that are looking to buy, is it a good time to buy and why? Do you want to rent or do you want to buy? All about lending. You're going to learn about it today. And I'll be waiting for your comments and questions. So that's why I'm doing this live video so we can ask all your questions. And we have a specialist here that can, an expert in the industry that can answer all your questions for you. But also, if you're looking to sell your house, also stick around because maybe you are looking to downsize or upgrade. Then what are you going to do then? Because you still need to buy a house, right? So by all means, without further ado, I would like to introduce Eric Elia. So go ahead, Eric, introduce yourself, please.
Thanks, Naveen. Hi, everyone. My name is Eric Elia with Home Financing Incorporated. Been in the business since 2004, almost a 20-year guy. Been doing it a long time. Had the pleasure to work with a lot of great agents like Naveen. So hopefully I can shed a little light on the lending process and offer some clarity for you guys and anyone that's got any questions and hasn't ventured out and begun a process yet. So
Okay, perfect. All right. So let me first go live on my laptop so I can start seeing your comments. 1 second. Uh, Let me join from here. Here we go. Oops. Okay. So now I can see all your comments. Perfect. All right. So, Eric, let's start with the basic. So, what are the different lending institutions? Which is better and why?
all right, so there's basically a big three. There's banks, right? Traditional banks. You've got Chase, Wells Fargo, retail offices. There's non-bank lenders. You've heard about them: Quicken Loans, United Wholesale, those type of institutions. And then there's brokers. Brokers take a large percentage of the business. Primarily, the banks are doing as far as percentage of volume across the country. I would say it's split primarily between banks and non-banks, but brokers do quite a bit of business across the nation. What's better? I'm always going to say broker. We'll start with banks. When you go into a bank, ultimately, or call into a bank, you're at the mercy of the loan officer that happens to answer the phone. I love competing against banks personally as a broker because our rates are always better. You've usually got just someone sitting at a desk taking incoming calls and doesn't have the customer service levels or the relationships with agents. Um, Usually doesn't have the experience because most loan officers that start out in banks end up leaving and becoming brokers. so so you deal with that. You deal with one person up front, but then you get passed along throughout the process to different people that handle different functions of the loan process. So that's a downside for anyone that needs to be navigated and walked through a purchase transaction, which can be very stressful if you're left in the dark and don't have someone at your availability to answer all the questions that come up. And there will be a lot of questions. Non-bank lenders, a lot of them, typically not everybody has a retail side, but it's kind of the same thing. It's call center based, it's mass marketing. You're dealing with one salesperson initially, and then again you'll get passed along. They're just larger corporations. My particular company, as a small brokerage, we keep it small intentionally, and I actually personally process all my own loans, so I literally conduct every aspect of the transaction from start to finish. And that just enables me to have the wherewithal to be able to update you constantly, to be your primary source of contact, to again answer all these questions that come up, because there will be a lot. It's an exciting venture, and it can be really helped by having someone available at your beck and call.
So,
So
Eric, one of the things that I know that banks, once a buyer apply with them, they have set of products that you just have to go with them. So basically, they can't shop for you for the best loan or the best interest. So that's another
yeah.
thing other than the customer service that you're going to get. But the banks are, correct me if I'm mistaken,
No,
right?
no, you're correct. Yeah, you definitely. I did highlight the customer service aspect, but yeah, as a broker, we do have the luxury of shopping different banks and placing your the mortgage based on the individual needs of a client and finding the most competitive banks. So that's one of the ways we have an edge on them is the maneuverability and the ability to find more aggressive loan products. A lot of the times, banks will limit themselves because they don't want exposure to certain aspects, like say FHA or they want to stay away from VA loans. So they won't even market it. They won't do it. So we have it all, and that is definitely an advantage of using a broker, not only for rate but program accessibility.
Perfect. So now you guys, you know the best lender that you can go to. I would highly recommend if you work with an agent, the agent will be able to direct you to, perhaps they're working with a great lender that they can definitely help you. So that's the first question. So um, another thing, Eric, that a lot of people when they are buying a home, they don't know what loan program to go with. So what are the loan programs out there, and what are the requirements for each loan program?
Yeah. So the most common loan program is conventional finance. You may have heard of Fannie Mae, Freddie Mac. Those are the basically the market makers for conventional finance. It's probably the most common loan you'll hear about marketed. Um, First-time homebuyer products, refinances, cash out refinances, purchase loans. They'll do traditional finance, credit scores down to as low as 600. Five, no, 600 is the cap for conventional finance, actually. They've got down payments ranging anywhere from 3% at the lowest for first-time home buyers, all the way up to, obviously you can go as high as you want on a loan as far as down payment, but that's the minimum down payment. And so it's pretty aggressive to have to only put down 3%. That's one of the most aggressive products out there as far as getting into a home with a low down payment is conventional finance. There's also FHA probably the second biggest loan product out there, which does have a lot of first-time homebuyer benefits, a lot of lenience on guidelines. They have a 3.5% minimum down payment option, so just a half percent higher than conventional, but they do go down to a 580 FICO score, and they have more lax debt to income ratio guidelines. So you can actually borrow a greater amount with an FHA loan because they will allow you to borrow a mortgage that puts your debt to income ratios, which we'll get into that
Yeah,
a
we're
little
gonna get
bit
into that
later.
in a second.
They're more lenient with that, so you can go higher. VA is another very popular loan product for veterans, veteran administration loan. If you if you are a veteran, thank you for your service, and it's probably one of the most ideal mortgages because they have a 0% down option and they have no monthly mortgage insurance, even if you put 0% down. So it's a very aggressive product. Government rates like VA and FHA, which are backed by the federal government, they do tend to have lower interest rates than conventional. So that's another plus side to them. So those are the three big ones. There's also hard money loans, which we personally don't do. Just to name a few, there's some outlying products that are out there, but the three biggest that you're gonna, as a first-time home buyer looking to get into a home for the first time, or just buy another home, buy a replacement home, conventional finance, you're typically going to lean towards, and I typically survey a client's resources, credit availability, down payment, and I determine what the best fit for you is.
This is great to know, Eric, because what happens is that I get some buyers and they have a really bad FICO score. And here you go, guys. I mean, you've heard that if your credit score is down to 580, 600, you still can purchase a home. It doesn't have to be 700, 800. That will help with the interest rate. I mean, the higher the FICO, it helps with the interest rate, right?
Absolutely. It's a pretty big common misconception that you need to have 700 plus scores or pay off all your credit cards in order to buy a home. And that's something that we definitely don't want you to do because you may be in just a fine position. You may not be improving your situation at all, having expended your resources paying down credit cards before you've talked to a lender. Because if you qualify as is, you want to hold on to as much liquidity as possible. You don't want to go throwing your money on credit cards when you're getting into a home purchase, which may create more expenses down the road with repairs and furniture and that kind of thing. So talk to a lender first, obviously, before you start trying to get your score up and pay everything off. Yes, you can get lower mortgage insurance rates, better interest rates with the higher credit score, but you'd be surprised at what's available with lower credit scores.
Perfect. Perfect. So the next question that I have for you, what are the qualification requirements? Basically, how do you qualify a buyer?
Well, we go back about 2 years, so and that goes for residence history. It goes for employment history, credit. They'll look at everything, but I'll start in a typical application taking process. My first conversation is what do you do for work? So we do a 2 year employment background check, whether you're self-employed or a wage earner for a company. I look at a 2 year work history. The longer the better. The more stable the better, but it's not going to really hurt you if you just switch jobs. I'm just going to look to make sure that your income is stable, determine whether I need to average it. Meaning, if you're not a salaried individual making a flat rate payment or flat rate income from a corporation, and there's variable factors like overtime, commission, self-employment income, then I'll have to do a deep dive and do a 2 year averaging. But if you are an employee for a corporation on very straightforward salary, that just makes my job a lot easier. And you can use that full qualifying income. We go off gross income, not net. So yeah, that's the starting point. And then residence history, obviously, and credit. We look at your scores. We talked about that. They have to be above a certain threshold. And then I incorporate your debt ratios. So
Yeah, that's another thing very important for you to learn about.
yeah, debt ratios is the biggest. That will determine how high you can go in purchase price. So, it's a matter of taking your income after I've determined what income I can give you for qualifying purposes. I basically take the proposed mortgage that we're trying to qualify for and all your debt and divide that into your gross income, and that produces what's called a debt to income ratio.
So,
And
Eric, sorry to interrupt you. What is considered a debt? What is a debt?
debt. So not everything that you would think that you pay, like electrical, gas, those utilities, those kind of things, don't count as debt. They're not included in my calculation. So a debt's going to be what's reported on credit, which is going to be student loans, credit card debt, installment loans, auto loans, anything that reports on your credit that kicks out a payment in a debt that I'm going to
What
be
about child
including that.
support?
Child support, absolutely, yeah. Any court ordered judgments that are against you, a lot of times they'll show up on credit.
Oh,
They don't always, but they will be flagged, whether it's through a divorce decree or a lot of counties will actually place judgments on credit so that anyone that any creditor that they're considering is
right.
is, is going to see that. So definitely that gets counted against your income as well. So court ordered liabilities like that are definitely as a factor of the debt to income.
So, what's the percentage with the DTI? So, this is called debt to income ratio. It's a DTI. So, what's the percentage that you look for?
Well, we have to stay under a certain amount. So FHA, for instance, it's about 55% to where they'll stop approving you, 55% and lower. Conventional has a hard stop at 50%. It starts at 45, but with compensating factors on your application, you can get approved up to a 50% debt to income ratio on a conventional product.
Okay.
VA is pretty similar to FHA, by the way, also.
So, if somebody has a couple of like car payments and they are, what would you recommend? Like, for example, paying it off before applying, or
No, absolutely not. Yeah. Again, don't pay off any debts before you've talked to a lender because again, you don't want to deplete your resources when you're getting into a very big purchase like that, and you may not need to. So definitely have that initial consultation with the lender before you engage on any debt reduction practices or anything like that.
right? Because I get that sometimes with the buyers, they say, okay, I have a couple of payments and I've heard so and so, so let me pay them off and then I'll get back to you about this. So definitely consult with a lender prior to paying off anything. All right. So sometimes I talk to buyers every day and they don't know how to qualify themselves. When are they ready? When do they know that they are ready to purchase?
Yeah, well, it's tough to do because there's a lot of marketing tools that websites that you'll see online that will offer mortgage calculators and such. You'll see home advertisements with payments proposed, predetermined. But what they don't tell you in that is those don't always include everything. They're always typically reading the fine print. You'll see, oh, must have a 800 FICO score with 40% down payment and that kind of thing. So if you want, if you know, in order to determine what kind of payment you'd be taking on a mortgage, obviously I always recommend call a lender, talk to a lender. If you want to do some work ahead of time on your own, make sure that you're using a very nuanced mortgage calculator that you can plug in the other factors of a home expense. It's not just the principal and interest payment. There's taxes and insurance that are going to be included in the payment on a monthly basis. There's potentially mortgage insurance if your down payment's less than 20%. There's potentially HOA dues, and all these are going to be a monthly obligation that you have to be comfortable with and be prepared for. So starting point is a very nuanced mortgage calculator. My website, which we can leave it here or I can give it to you guys, but it's got a pretty detailed mortgage calculator that you can plug in all those details and it'll give you a good idea of what you're engaging. As far as being able to qualify yourself, that's a little harder to do, but there's a pretty simplified calculation if you want to know establish a range. So we talked about debt to income ratio, what gets factored into that. So let's say we've got a $10,000 a month gross income straight salary, just for for simplification purposes. The mortgage payment after you've engaged a mortgage calculator to determine what a payment's going to be with tax and insurance is $4,000 a month out the door. Just for again, for example's sake, you're already dividing 4,000 divided by 10,000. You're already at a 40% debt to income ratio just on the housing aspect. Then you look at your debt. If you've got $600 in minimum payments, when I say minimum payment, a lot of times you'll be making if your credit card balance is 2,000, sometimes you'll pay a couple $100 a month, but they don't go off what you've been paying. They go off what that minimum payment calculation is, that's on your statement each month. So take a look at all your credit cards, your auto loans. If you've got child support or anything like that, consider that. Add it all up to the mortgage payment that you calculated and divide that by your gross total income. So if you've got debt totaling $1,000 a month, $4,000 mortgage payment, divide that by your $10,000 salary, you're at a 50% debt to income ratio. And that's basically how you can determine the range you're at. The mortgage calculator will have told you what the purchase price would be to get to that 4,000 payment. So that's a good starting point. Very rough calculation. So again, don't try to go making offers on homes based on that calculation. Talk to a lender, get pre-qualified, but that's a good starting point for.
But Eric, correct me if I'm mistaken, just if we can put it in simple terms to everyone. If you guys have steady income for a while, like you have a job basically, and minimum 3%, 3 to 5% down payment, saved money, right? Of whatever house that you're looking, for example, for 800,000, then you want to have like 3 to 5% of that. And then how much for closing costs? 2%.
Yeah, so that's the other factor. Qualifications one, and then obviously the money, right? So yeah, minimum down payments, like you said, Naveen, 3 to 3.5%. On average, what I advise clients to allocate for closing costs, on average, 2% of the purchase price. It can end up being a little bit less, but it's a good average to
Yeah,
allocate. So, and it's a big factor. It's almost as much as the minimum down payment in some cases, and a lot of individuals forget that when they're starting out this process and haven't talked to a lender that's informed them of that, and you can end up needing to postpone your entire search to save up another 2%. So definitely allocate for that. There are some tools that we have at our disposal. We can in some instances offer lender credits to help absorb some of those costs out of pocket. But there's a cost for that. That you basically take a higher interest rate when you've got a lender credit. You get a lower interest rate when you don't have a credit and you fund your own costs. But those are tools that you can ask your lender about, and he can explain in detail as far as what that would cost.
that's perfect. So now at least you have an idea about how to, when you are ready. Again, I mean, as Eric said, you will never be 100% sure that you're ready unless you speak to a lender. But at least that gives you, just some borderline for where to go. All right. So the biggest question is, how do you foresee the future of real estate, of interest rates, of mortgage rates? Everyone is complaining. Everything is going up. So how do you foresee this for this year and next year?
Yeah, well, obviously interest rates, if you've been monitoring the market at all, it's been a tough year so far. We just got out of a 2 year, record low interest rate environment. Um, we pay attention to the analysts. No
Right.
no one has a crystal ball, but they have been going up pretty much in a straight line since the start of the year. So our forecasts, obviously inflation has been a part of that. Rates rise with inflation. and now we're seeing our government take action to kind of circumvent the inflation rates that have been soaring and making all your prices go up on food and gas and everything else. Home values have been climbing right there with it just as fast as everything else, and rents. So we do expect the actions that the Fed is taking today to reduce inflation, with their raising the core lending rate and thereby reducing demand of businesses and banks from borrowing money and just spending it freely, to kind of curb demand and tame inflation. And rates are going to follow suit. They're going to come down with it. It's a matter of when. We think that that it's going to take a little bit of time. It took us a while for inflation to get up here, and it's going to take a little time to come down. So it's going to be a process, but within a 12-month period, we expect some reprieve from the current interest rate environment. Although we do think we're in for a little turbulent time for the next few months, at least until the effects of the Fed's actions start to actually help us and not hurt us. So long term, we see some improvement in the near future. Home values, obviously they've been climbing high, right? 20% year over year. That's gonna be cut in half, if not more so, based on the analysts that we trust and follow personally as a company. We're expecting single digit appreciation growth rates into the future on a 12-month outlook. Long term, we expect it to stabilize and go back into the the mid single digits great appreciation rate on an annual basis. And that's what we really need for stability for a normal market environment that we haven't been experiencing over the last year or two with these appreciation rates. So that's what we'll get back to after inflation is tamed.
So we're still expecting home prices to go up and continue appreciating, but with a slower pace. Interesting enough, I was recording a video about the prices in Southern California back in 1985. Interest rate back then, the average was 13%. And today, actually, I had a training, and the trainer was saying it was 18%. It was crazy back in 1985, or in the 70s as well. But here's the thing: the home price. That's what I found in my research. That the average home price back then in California was 114,000, and the average annual income was 27,000. So the average home price was 4 times the average household income. Fast forward to today, 2022. Guess what? The average household income is 98,000, and the average home price is 470 or 80,000. So almost the same ratio, but with 5% interest rate. So we are not doing any different than back then. It's just, I guess, we got spoiled the past 2 years with the interest rate being in the three and fours, right?
We certainly did,
Yeah,
and it was like that for a reason. They wanted to prop up the government. The government was literally buying mortgage-backed bonds, which were helping keep rates low. So it was no accident the rates were low. It was by design, the government's actions to spur the economy, and yeah, and now I think we're experiencing the after effects of possibly 2 years of lockdowns, the impact that has on the economy. We've got a war going on. We've got supply chain issues, for all these reasons, with demand still riding high. Yeah, everything's going up. So
so looking at talking about the interest rates, you just mentioned that in the future it's expected to go down. um, then should people wait? Should they wait to buy a home?
absolutely not. I mean, if you ask me, I'm always going to say, when's the right time to buy? It's today,
Right.
or yesterday. And there's really no safe haven from the rising costs of rent and home ownership. So waiting. I mean, if we already know home values are going to go up, whether they go sideways for a year or two, on a 10-year horizon, you're going to be in a better place than you are today if you buy today. It used to be that you had stable rents you could rely on and sit and comfortably wait and rent and sit on the sidelines, which was never a good idea in the first place. But now we've got rents appreciating at the rate almost on a parallel with home price.
Exactly.
We've seen what, just about 20% year over year rent
Yeah.
rent prices. So it's not a safe haven. You're not accruing equity. Home price, you're not capitalizing on the home price appreciation of the money that of the leveraged home. An investment, basically. The way I like to look at it is, it's a leveraged investment when you're taking your savings as opposed to just sitting on it and renting. You're actually borrowing. Whether if you put 20% down and take an 80% loan to equal the amount of your purchase price, that's 5 times leverage on your money. and you take that at the annual appreciation rate of a home, so you're getting 5x return on your money at the rate of a home appreciation, which is 5 to 20%. So it's a huge wealth making opportunity that you really need to get yourself in a place to do it immediately, right away, today. There's no benefit in waiting. It's just gonna get worse. It's gonna cost you more
Exactly.
down the road.
And that was my next question, which she answered, which is to buy or to rent, and definitely buy now. The rent is going to keep going up. The home prices are going to keep going up, and you are losing, right? You are losing your net worth. You're losing equity in your home. So definitely buying now is better. And if the interest rates goes down, then they can refinance.
Yeah, that's one strong consideration. Obviously, a higher interest rate market, you're not married to the loan that you use when you get into your home. So if we do get that reprieve we talked about in interest rates, and that turns out to be correct, a year down the road, you can just refinance the existing mortgage you have and capitalize on those lower rates. So um, getting into a home now, even though the rates are propped up, waiting is not, you're missing out on a year's worth of home appreciation. And not to mention that every month, every payment that you make towards your mortgage, you're paying down your principal. So you're actually achieving more equity through two different avenues: through home appreciation on the market, and through paying down your mortgage manually via your mortgage payment. So
Exactly.
don't wait.
So being in a seller's market, that means the inventory is very short, and you know there's not a lot of inventory houses for sale basically in the market. And I think one of the reasons is that sellers are, let's face it, I mean, they're going to face the same thing. What's going to happen if I sell my house? I mean, I have to buy a new one, whether you are downsizing or upgrading. Now what? How would you recommend? What would you recommend to those sellers?
Well, that's a personal need basis, right? People looking to downgrade are looking. It's a more preferable situation if you have the luxury of being able to downgrade, and maybe maybe the kids have left home and you want to get a smaller place. You don't need a two-story. You don't want to go upstairs anymore. I mean, that's a that's kind of a no-brainer, right? You're taking a larger home, applying your earned equity, and utilizing it on a smaller home, and that's going to actually help your affordability in most cases. Upgrading, a little more challenging because you are taking on a little bit more of an expense, right? Higher purchase price means higher mortgage payment, higher property taxes, but you have to, again, it's a case by case scenario. If you've got a growing family and you need that, then that's what you got to do. And the best way to plan for it is, like I said, just utilize some of these tools. Go online, go on lender's website and utilize a mortgage calculator and see what it's going to cost you. Talk to a lender about it. Yeah, that's
But again, because it's a seller's market, it is the best time to sell right now because this is the highest equity you're going to have probably in your house is right now. And we've seen a little bit of a shift in the market. And when I say shift, I don't mean shifting from seller's market to buyer's market. Absolutely not. But shift in the number of offers that we're receiving on a listing. So last year, we used to receive like 30, 40, 50 offers on a property. Now down to 10, between 5 and 10, something like that. And that's because, again, the interest rate has gone up, right? So the number of buyers have decreased. So if you are a seller, if you want to sell, but you are on that edge, uh, talk to an expert. Talk to me. I can refer you to Eric. See your options. Yes, we will have to go through the same of finding a new home for you. But again, you will get a lot of down payment that from your home, from your equity, that you can put it as a down payment for the new home. Okay, so that's definitely a plus for you. So any last words, tips, nuggets that you wanna, advise people with buyers and sellers in this market?
Well, I would say, I mean, we did cover a lot of ground today. First and foremost, I'd say call Naveen. Get her analysis on markets wherever you're looking. She can help you in any market. Um, but utilize these tools we've gone over. I mean, whether you're on the fence deciding whether to buy, waiting is not going to do you any justice. You're just going to miss out on potential wealth over the next year. And there's no you're not going to get a cheaper home. They're going to go up. They're just going to slow down. As far as the appreciation rate, we're not seeing a reduction in price, and it's not being forecasted by any professional analyst. So, you know, get yourself in a position. You can do so with simple tools like like doing your own rough calculations, but call a lender, have that initial consultation. There's a lot you can learn. I've got a ton of long-term prospects that aren't in the position, aren't ready, but they reached out and had that initial conversation. And now they're on a game plan. I put them on a plan of what they need to do, what credit events they need to address, how much money they need to save. There's so many things that you can learn from just these initial consultations with industry professionals like Naveen and myself. So don't be shy. Reach out and make those phone calls. That doesn't cost you anything. We're here to help. Our services are free. And we get paid through the transactions themselves, but everything we do is just designed to get you in a position and
Right.
help you. So, yeah,
So
take
last thing
advantage.
that came to mind right now when we're talking about the market, I was having actually a call with Dustin with one of my buyers a couple of days ago, and Dustin is our purchasing director of the same company. And the buyer was under the impression, and he wholeheartedly believed that the market is going to crash and there will be a lot of foreclosures coming up, and then he can buy any house he wants, cash. What would you say to those people that are waiting for the market to crash and foreclosures to increase?
Yeah, so it's pretty fresh on a lot of people's minds that endured the crash that we went through back in 2008, 2009. And the first thing I say is we're in an entirely different market than we were. There's a set of circumstances that created that recipe for disaster that caused that big crash back in '08 and '09. Number one, the mortgages that were being utilized leading up to that event were very lax. So stated income loans, just no qualification. People weren't legitimately qualifying for their payments. They couldn't afford the payments they were signing on. They were stating their income. They were not putting any down payment whatsoever. So they had absolutely no equity, no cushion. In some cases, they had negative equity. There was some loans out there that you could actually pay just a portion of your payment due every month and just throw the tail end onto your loan balance. So you'd had rising balances in some situations. So that was a huge driver. And the minute that the rug got pulled and all these banks and institutions that were holding these loans started to notice everybody was defaulting on their loans, it just imploded immediately. Not to mention there was a ton of supply on the market back then. We talked about we're in a
Exactly.
low inventory market. Back then, leading up to that, there was too many homes for sale. The biggest drivers of home price is supply and demand. To simplify it, and we just had a ton of supply, and when the demand fell through the roof because we were enduring a crash and a recession, that just basically chopped the market in half. So what's different now is lending guidelines have tightened dramatically since then. All these banks got burned, so no one's writing those loans anymore. Over the last decade, we've been writing loans that people legitimately can afford their payment. They're qualifying for it legitimately, and they can afford these payments. It's on conservative debt ratios. That's why we look at all that. So we're not having, and not only that, but um, adjustable loans used to be the most prominent loan written back then. 30-year fix have been a majority. Just our company alone, I would say 95% of our business has been 30-year fixed mortgages because they've been the most aggressive. It hasn't made sense to go into adjustable rate mortgages. So um, difference from back then, a lot of people's payments started jumping up and they just couldn't afford it. And when they saw the values coming down, payment going up, they walk away, they foreclose. And it just became a tidal wave effect. So we're in a much more stable market. There's not enough homes out there. There's still way more demand than there is supply, and that's going to keep prices stable.
Don't you agree that the market was better in terms of price and interest rate like 4 years ago? Believe it or not, 4 years ago, I had some buyers still telling me the same thing. I'm waiting for the market to crash, and until now, they're still renting.
Yeah.
So they wasted a lot of opportunities. So if you are looking to purchase, talk to us. We are the experts in the industry. We'll let you know what's good for you. So there is a comment here. Somebody is saying that the issue is how to secure a 3% down payment with all COVID and inflation events. Um, that's just a matter of saving.
It's budgeting. Yeah, just
Yeah.
just responsible budgeting. Obviously, the resources to be able to accrue down payment is, you have to be in a situation that you do have a little bit of surplus on your monthly income after your debts are paid. and that's just responsible budgeting is the only thing you can do. Get yourself in a position to earn as much as you can. Unemployment's at a really low rate, so as far as the employed percentage of the population of the nation right now, we're in a good place. We've already achieved pre-COVID levels, so there's been a huge recovery in that regard. Most people are working, so the incomes are rising. That's one benefit. The incomes have risen,
Exactly.
maybe not at a pace that we'd like to see,
Yeah.
keeping up with the cost of everything. Obviously not. That's why inflation is 8%, or and scheduled to go higher. Um, but we have seen some growth in income and employment. So, hopefully you're in a position to budget properly and just save money over time. There are down payment assistance products out there that can help get you in a home.
Not in this market.
It's tough. Yeah, there's trade-offs, right? Because
Yeah.
the biggest trade-off from taking down payment assistance grants, and they're disappearing. A lot of these grants are drying up because the interest rates aren't sustainable and money is tightening. But the trade-off, just in general, if you do, there's Cal HFA is a state-sponsored product that does offer down payment assistance in which you can borrow your down payment. Basically, it's a no payment second mortgage that gets added on to the balance of your first mortgage, and you don't pay it until you either refinance or sell your home. So, and then there's no active payment that you're required to make. So it can be a useful tool to get you into a home initially. Trade-off, the rates higher and the fees up front are higher. So there's some pros and cons to it. Happy to explain the nuances on individual consultations. It's more of a case-by-case scenario, but yeah, it's out there. So again, reach out. Whether you've got the money or not now, I'm happy to help long-term planning and help put you on that right path to getting yourself in a situation to be able to
Let me
qualify.
just reiterating about what Eric said about the down payment assistance program. I mean, we as agents, we are on the front side of the battle. Lenders, I mean, they're helping us, they're backing us up. Um, when we're listing a house, and we always say cash is king, right? And we have like 10 offers in which maybe half of them or even more, they're all cash and above asking. And I have the rest very good qualified buyers and they're financing. And then I get one down payment assistance program. Do you think it's really gonna look anyone would look at? This is the problem with the seller's market. So because I get asked about this and I said, not in this market. I mean, Eric is saying they're still there, but I just want to be open with you and frank with you. Um, when I'm submitting offers as a buyer's agent, it will be hard for me to submit an offer knowing that kind of like I don't want to say wasting our time, but you know what I guess?
Yeah,
It's
obviously.
challenging.
Yeah, yeah. Obviously, it's not the most appealing offer when you've got to disclose that you're borrowing your down payment. It doesn't scream strength, right?
Right.
Um, and it's these products are designed for not necessarily low income borrowers. They do have income caps tied to them. So if you're making $400,000 a year, you're not going to be able to get down payment assistance because they're designed for first time home buyers with lower income to help people get and start to get into their first home. So that's one aspect. So again, if you're in a competitive market in a very populated area, most of the home values are pretty high up there, and down payment assistance just isn't that common. You don't see it
Exactly.
in very high areas, high populated areas, but there's some uses for it. So if you're looking at different areas that maybe don't see as much volume and have lower purchase prices, ask your lender about it.
Okay. I think we covered a lot of things. I don't see any questions here. No more questions. So thank you so much, Eric, for all the information that you
Yeah,
provided
yeah.
today. And if you're watching this on a replay, feel free to still drop your comments below. I will definitely get Eric to reply back. And then again, if you would like to reach me or reach Eric, just reach out to me. Eric, we work together in the same office. And by the way, I am recording from our Whittier office today. This is our beautiful media room that I love. And so reach out to me at any time. My phone number is always below this video. And thank you so much for watching. And until next time, bye for now.
Thanks, guys.
Ready to make the call?
Yes, I'm done with the live video.
Nice.
I'm turning it off. One second.
Okay, let me know.